Okay, so we always start with our disclaimer. So the opinions expressed in this presentation are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or specific security. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risk. This information is given in summary form and does not purport to be complete. While due care has been used in the preparation of this presentation, and the information contained herein has been obtained from sources believed to be reliable, its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside of our control. Past performance is not a reliable indication of future performance. Um, as I go through these charts, please feel free in the chat to enter any types of questions you have. We like to make this, again, as interactive as possible. There were a few questions that were submitted at the beginning that we will address at the end of this presentation. But if anything pops up or you want me to go back or go in more depth on something, please feel free to throw it in the chat. So change the approach a little bit to how we view this data to try to organize it more into different sections. So it should help with flow and how we all understand what we're looking at. So the first thing we always look at is our monetary policy and interest rates. These are super important because they really determine what direction the economy is going in, whether lending conditions will be loose or tight, meaning is money flowing or are people scared and holding on to it? What we've had happen is our interest rate or our yield curve has changed because the Fed has been cutting rates. And normally, when you see the blue line here, which is our current interest rate, our current interest rate yield, our current yield curve, when you see it return to this level, technically that's a normalization signal that says the economy markets are healthy. But the caveat here is that when you look at it from a year ago, it was the red line, right? Almost completely opposite. You have this inverted yield curve. And historically, when we see this shift happen, where that short end has come down, the long end has gone up, it's a transitionary period. It could be pointing to better economic outlooks, several years down the road, or it's just in this sort of wonky phase where things are changing. There's a lot of uncertainty out there, and we just don't know. Historically, when the yield curve uninverts, which is what is happening here, right, with the blue end going up on the right side higher than the left side, is a normalization, right, uninverting. Historically, that's always preceded a recession. And you can see in this chart, this is looking at different yield curve uninversions throughout the past 40 or so years. In the 1990s, right, the yield curve dipped negative. We've been negative for a long time, then it uninverted, and 6 to 12 months later, recession, right? Uninverted again in the early 2000s. 6 months later, recession. And again, 2006, 2007, then recession and the great financial crisis, right? This happened here, and then COVID hit, which is odd because, like, how could that have all lined up? But somehow it did. And now we're uninverting again. So the question going forward really is going to be, what does this mean? Does it mean that we are headed for a recession in the next few months? When we break down the data, which we'll get into, there's a strong case to say that a lot of the potential new policies that could be put in place should lead to inflationary pressures that could theoretically harm the consumer even more. And remember, the consumer or consumption is 70% of our GDP. And so if we're not in a healthy spot, the economy is not really going to grow. So to be determined, it's one of these risk indicators that we track, but these things can take months to play out. This was interesting. This is the CME Fed Watch tool. So what they do is they're sort of tracking what the interest rates are probably going to be in the future, right? So how many rates are being cut? How many cuts are there going to be? Are they going to raise rates? Last year, they were saying there's going to be 7+ cuts in 2024 and then a whole bunch more in 2025. And there's only been a small handful. And the new projections forward say that there's only going to be one cut in 2025. So Why this matters is because if there are a bunch of cuts, it's saying interest rates are coming way down, credit is then cheap again. Theoretically, you could look at that as a way to spur the economy because access to credit's easy and money's cheap. So why not take a loan? Or if you're a business thinking about growing, you're going to take a loan out because it's cheaper, right? Whereas if the interest rate rises, it gets more restrictive because you're going to second guess, should I take this loan out? I'm going to have to either make a lot of money to pay off the extra debt. So the fact that they're saying or projecting that there was only going to be one interest rate cut really changes from the rhetoric of last year. To me, it really just speaks more to the uncertainty in our current environment, sort of a lot of wait and see happening out there, which we'll get into in some more of these charts. Um, so risk indicators. This is something that Alexandra has looked at for years. She really taught me extensively about these types of metrics and why they're important because they really show like when cracks start to form. The first one looks at bond spreads, right? And I probably go over this every time, but just to hammer the point home, this is looking at the spread between a corporate bond and a government bond. And if a corporate bond's paying, say, 5% and a government bond's paying 4%, the spread is 1%. Okay. And so when that spread increases, it's saying, hey, I will buy this corporate bond, but you need to pay me more, a higher percentage rate. You need to pay me more in order for me to take on that risk. When you see that spread tighten, it's saying, nah, there's less perceived risk between this company and the US government. And so what we've seen is really this tightening of bond spreads across the board. I've been trying to get to the root of why this is happening. And I've heard probably 15 different answers from people from all over the financial world weighing in with their opinions on it. Some say it has to do with the yen carry trade. Others say it has to do with rising risk of the US, so that, hey, corporations actually aren't as risky as the US government. Other people say it's because the strength of corporate balance sheets is very strong right now. And so they're not as, that perceived risk just isn't there. Um, I think it's probably a mix of all of these different factors, but the fact is, if we were to see spikes in this area, that would be a huge warning signal. We're not really seeing those spikes right now. So that's generally a good sign for the health of the economy. Here's credit default swap spreads. This is like an interest rate, or I'm sorry, an insurance product is a way to think about it on an underlying company or country or municipality or whatever going bankrupt. So you buy the credit default swap. And when this spread blows out or increases, again, it's saying, hey, the chances of this underlying company or country or whatever going bankrupt has increased exponentially or significantly. And when it gets tight, it says, yeah, the risk of default is pretty low. These haven't blown out. And you can see, right, during COVID, there were some huge spikes in here, a lot of uncertainty. There were some bank failures in 2022, some big spikes in uncertainty. But since then, it's really sort of trickled down. So these markets or this risk gauge generally is just saying that, you know, things aren't too bad. This is the same thing, just looking at sovereign governments or different governments and what their risk of default is. You know, we look at the USA, China, Germany, Brazil, Japan, a whole bunch of different countries. As of right now, there's, I think, some elevation on the right there for Brazil, but it's still not at levels that would warrant panic or anything like that. And then volatility, just a gauge of, you know, the implied moves in markets looking forward based on the current environment. When you see volatility spike, it says that dollars are changing hands extremely fast and that there's lots of people panicking. That bottom few lines look at sort of the stock market volatility, and the top blue line there looks at the bond market volatility. And bond market volatility has been increased because over the past year, really, the Fed has been raising interest rates, and it's caused a lot of changes in those markets. And you can see that reflected in that 2020 to 2022 increase. But since then, it's sort of generally trickled back down. So these gauges pretty much say that, you know, things generally are okay in these markets. Credit spreads, CDS spreads have not blown out. The risk of defaults has not significantly increased in these markets, or at least that's what this data is suggesting. Yeah, liquidity risk. Liquidity is super important because you need to have liquidity to pay off things. And so when you're an insurance provider or um, a hedge fund or any type of different financial institution, you need to have access to liquidity in case you need to pay off a loan, you need to buy something, whatever it is. And so I won't get too far into the weeds in this because it's a little more esoteric, but what we want to see is that there is ample liquidity in our financial system because when it dries up, things break. And that's really how things like the Great Financial Crisis happen. Where there's not enough liquidity, people start fire selling things, buying or selling at discounts, and it can lead to a whole host of problems. Uh, Cyclically, based on these metrics, things look okay, but it does look like there is this turn in liquidity, and so it's something we want to watch. This isn't saying like we need to run for the hills or anything right now, but it does signal that, it is an ongoing issue that is worth paying attention to because if liquidity is to dry up, which it's pulled back some, but it could always just be, mean reversion or whatever in its current trajectory. But if it continues to go in this direction, it does increase the risk that there could be larger drawdowns in markets. All right. So I know that was a lot I just threw at everybody. All right, deep breath. All right, so now I'm going to look at some economic activity. Things like the leading economic index. And we track this because it's really a good gauge of, what Main Street's feeling. Historically, whenever this blue line has breached that, the sort of black and red dashes, it's been a recession. It's a recessionary signal. It means the economy is contracting. Now we've sort of been in this negative stage since 2022, yet the officials have not called a recession. And there's lots of nuance around this. We do believe that the price of goods has gotten more expensive. Wages have not kept up, and we'll look at some of these charts as we go along too. So there probably should have been some call of a recession, but other metrics have held up. Headline numbers, certain things, sort of top level, have looked really good. And so we wonder, has the data been fudged or what? Because the experience of many people is that things are harder than they were. And typically that goes along with a recession. This data now is starting to come out of that recession signal area, which is generally a good sign. I mean, it would say that, hey, there's some economic growth. But it's then important to really look at what are the constituents or the pieces that are accounting for that change, for that economic growth. And when we really look at what it is, it's mostly the stock market. The stock market's a major contributor. According to this, building permits as well have been a big push forward. So we'll continue to watch this and see how that plays out. CPI, Consumer Price Index. So this is sort of one of the major gauges that regulators and the government use to track, like, hey, is inflation going crazy, or is it not? Now, inflation did go crazy, as we all know, as you can see in this sort of 2022-ish time period, and it has come down pretty significantly. But really, over the past year, it's hard to see. I could, maybe zoom in there if I could, but it's still at a very elevated level. So things are very, very much so more expensive than they used to be. It's actually starting to tick back up. And what one of our major concerns is that many of the new policies proposed theoretically, and we don't really know yet because we don't know how these policies are actually going to be rolled out and implemented, but theoretically they should add inflationary pressures. And so we've already started to see this small tick up, and so it will be important to watch this number. We're watching this number anyways to see if it continues on higher or if it's just a blip. All our data points to the idea that if it doesn't go much higher, it's not going to go much lower. It could be range bound, if anything. So this is looking at necessities. So you can break apart the CPI into a whole bunch of different subcomponents. Here I'm looking at food, shelter, and energy, because these are three necessities that we all need to survive. And you can see really just how, I mean, the 1950s, or well, the 1980s here, the price of this stuff has gone up I mean, 400% over this time period. And you can see this really increase in the rate of change since 2022 in things like shelter. I mean, we all know the housing market is crazy, and it still is. Um, Energy prices, I mean, they're way above where they were even a decade ago, almost doubled. And then food prices as well. So these are not typically counted in the CPI numbers, which is interesting, but these are the ones that are more the lived experience of people. And so that's why we feel it's very important to track this kind of stuff. Um, so this is looking at the producer price index. So this is the price that producers or manufacturers or anybody who's building or making a good have to pay in order to make their products. And you can see really since 2022, prices have gone up huge post-COVID, and then they've come down some, but they're still at these very, very high elevated levels. And so this is saying that producers or people, manufacturers, people who are making products, they haven't seen any of this disinflation or the that huge price drop that we saw in the CPI chart. In terms of producers, they haven't felt it. So it's either price gouging happening left and right, and even the producers are being price gouged, and it's sort of passed along all the way, or it just shows that the prices of things, the pressures are still there, and that there are still issues that haven't been worked through fully. Here's a wild one too, building materials. This is just looking at the cost of building materials. So lumber, nails, screws, all these different things that go into building a house or a factory or an office building. The price of this stuff has just gone nuts. And while it came down from some extremes, it still is tracking higher. Ultimately, this means when Alexandra and I look at this data, it says that, hey, prices of things are not going to come down, especially in this space. It's still super expensive to build a house, and based on the data, that doesn't look like it's changing anytime soon. The ISM manufacturing, this is an index that tracks general manufacturing in the United States. When it's below 50, typically it's contracting. It's not necessarily a good thing. It's saying, hey, manufacturers are not growing. They're actually slowing their production instead of increasing it. It has ticked up last month, which is great, but it's still below that 50 mark. And below the 50 mark, again, contracting, above growing economy. What we'd like to look at is sort of the rate of change and direction of the different components of this index. So it looks at like new orders, employment in this space, deliveries, inventories, prices paid, all these different things. And then generally, what direction are they going? And it's a mixed bag. I mean, you've got contracting, growing, contracting, slowing, contracting. So it's undetermined. It doesn't look great. If it was truly a booming economy, you'd want to see this turnaround. You'd want to see the rate of change moving faster and everything in the contracting to at least flat to growing. So we don't see that yet. I know this is always sort of backward looking by a month or so. So it'll be very interesting to see what the next months come out as. But as of right now and where we are, it still says we're in this. And even if it does break above that 50, will it hold or will it come back? To be determined. That's sort of the theme of this conversation right now, is that there's a lot of uncertainty out there, and I'll sort of recap this at the end. But one of the key takeaways that Alexandra and I want you all to have is that really over the next, say, quarter, the next several months, there is a lot of unknown. There is a lot of uncertainty around how the world is going to change and react, and what the actual policies the new administration is going to be, and how they are going to affect people, the economy, markets, manufacturing, services, everything. There's a lot of speculation on that, but all we can really do is look at the data as it is and sort of use our intuition and brains to look forward and say, okay, based on what we know, where does it look like we're going? So here we have, there's a couple questions. Just notice these. All right, I'll get to some of these questions at the end. I think that might be more appropriate. All right, so wages over the past year really wage growth has come down. I mean, significantly. Why? Because employment is at a decent level right now. There's less reason to pay people more, apparently, when they don't have to, or when companies don't see the need to. This always concerns me because generally you see this contracting. It means companies are doing great, but people are, not in the same boat. That's my next chart. Okay. Here's a chart by the Fed that looks at global supply chains, and sort of below this black line here. Below this black line here generally says things are stable. This is a good sign. When it's above, it's like things are really messed up. And we saw that during COVID. You can see that huge, huge spike up, 2020, 2022, 2022, 2022. This whole period, supply chains were really messed up, as we all know and all experienced. But since then, they've normalized some generally, which is good. Although prices of things haven't really come down yet again. So it's, still negatively affecting the consumer. But at least global trade is less constrained than it was. So generally, that's a good thing. Here are some charts that look at freight. The first one looks at for hire truck tonnage, basically how many trucks are moving around the United States and how much tonnage they have available. And what's interesting here, I find, is that really since 2019, it's been flat. And so there really hasn't been a big increase in the amount of trucking tonnage shipping around the United States. So it's interesting to see this flat in things like manufacturing, right? Sort of in that negative contracting territory. It doesn't bode well to a booming economy, or it doesn't speak to say, yeah, if all metrics are great, you'd see this increase because more people are shipping things, buying things, renting out the tonnage space, hiring trucks to move goods from one area to another. And we're just not seeing that, which is interesting. And then the latest print, which I believe was from last week, there's a bigger downturn in these things. So something to watch. On the right, we're looking at Asia to US West Coast spot rates of boats, right? So what it costs to rent out container space on a massive ship and take it from wherever, Shanghai, China, wherever, to LAX, the United States, right? There were some huge upticks earlier in this year where the rates, 4x'd pretty much, or 5x'd in some cases, where a shipping container, just for rounding purposes, say, used to cost like $2,000, then it cost $10,000. I mean, that's wild. They've come down. Now, is that a good thing? On the one hand, yes, it's cheaper to ship goods, so that's a positive, but the other could be a supply demand issue where, the demand was there that really commanded these prices. Is that demand just not there anymore? That's the question. All right, switching gears to consumer health. All right. So, like I mentioned earlier, unemployment generally is at a decent level. I mean, it's slightly above 4% unemployment. That's the current rate, meaning 96-ish% of eligible people working are working, which generally that's great. Especially you see the spike post-COVID. I mean, wow, unemployment was at 15, 16%, probably was even higher than that. But, this is directly from the National Bureau of Economic Research. And they're printing unemployment as 4-ish%. So it says, hey, the labor market is employed. That's a good sign. When we dig into the components of this, though, it starts to paint a slightly different picture. And this is something that's worth paying attention to because, again, the headline number, 4%, great. But where are those jobs? Who is unemployed? Who is employed? Who's hiring? Who's not hiring? When you look, it's really retail services, leisure and hospitality, government jobs, and healthcare and social assistance are where the major job employers are. And things like manufacturing, utilities, trade are contracting. So again, it speaks to the idea of in a very healthy economy, some of those manufacturing type jobs are solid blue collar, they pay well, they create a strong middle class. whereas service jobs are generally pay a lot less, right? And so do you really want to see a huge increase in service jobs and a decrease in manufacturing jobs? Because what does that really signal about the economy? Yeah. Something to pay attention to. Consumer confidence. So there's a few different confidence indices out there. I don't put too much weight behind these other than to just confirm or show a general trend in sort of like the attitudes of the public. You can see really since 2020, like right after COVID, consumer confidence just has not moved back up. I mean, from 2009 to 2020, it was essentially straight up saying, people were feeling like the economy was getting better, feeling like their lives were getting better, feeling like they were being paid more, feeling like all's good. And then COVID happened, and really since then, it's sort of flatlined. And so that's concerning, but I think it really speaks to the idea of something we've talked about in the past of a K-shaped economy, number one, where sort of the top 10% are much, much better off and able to withstand all these increases in prices than the bottom 90% who've had a much different lived experience. And so I think that really reflects in this type of chart. Here's two more that look at sort of the index of consumer sentiment over the long period of time. I mean, the one on the left, University of Michigan has done this for decades, goes back to the 1960s. And you can see in this period here, I don't know if you can see my mouse, but the 2017 to 2020, it was generally, things were pretty good. But then COVID hit, and yes, it's bounced back, but it's still less than half of what it was before then. So again, it speaks to that idea of while a part of the economy is doing well, another part is not doing well. Yeah. The chart on the right looks at sort of inflation expectations. And this is interesting because it's not so much gauging like, is there actual inflation? It's more a reflection of what people's experience of inflation is and if they're feeling it. And you can see really the latest prints here have that looking forward, most people are expecting inflation to continue higher and they feel those impacts. So that again speaks to that idea when we were looking at that CPI number that came down significantly, but then sort of ended out there and then ticked up a little bit. The expectation is that it's going to continue to go up too. And that's sort of the consensus around a lot of folks who live it. There's another gauge that, sort of like alternative data, but used vehicle prices. This is interesting. It just shows how after COVID, used vehicle prices, I mean, doubled pretty much. And they've come down, but they only came down by, I mean, I guess that's 20-ish% or so, but have since leveled off and have actually started to tick back up. So used cars only 10 years ago were like half the price that they are today. And based on this trend, it doesn't look like that's changing anytime soon. With the chart on the right really shows the year-over-year changes in different types of vehicles and prices, with SUVs and luxury cars really continuing to increase in price, while EVs have taken a big hit, along with compact cars. Yeah, so just an interesting data point to pay attention to. Here we are looking at consumer credit and debt. And I'll try to go through this quickly. Just basically that, as you all know, we're always watching debt, and debt continuously goes up. Most of the debt looks to be mortgage and student loan. That is where the major increases have come from. Some credit card. I have seen a few articles out there that are like, oh my God, credit cards are at record rates. But if you look at the right, it's really the credit card limits have gone up significantly. I don't know what your experience is, but personally, I've been reached out to by 2 or 3 different credit cards that I have saying, hey, we want to increase your limit. We want to increase your limit. Okay, sure. Doesn't mean I'm using it more. But you can see in the chart on the right here that those limits have gone up significantly. And while balances have increased, that's that dark blue line at the bottom, it's not massively. So if we saw a much, I mean, it is picking up, so it's something we want to pay attention to, but it's not, as of today, in my opinion, signaling that that there's a lot of worry here. What is worrying is the loan delinquency rates. Um, this is a noisy chart, so I apologize for how it is, but this is straight from the Federal Reserve Bank of New York. You'd think they might want to show it in a more digestible fashion, but basically, the red line is student loans, and we know these have been forgiven a whole bunch and a lot of the stuff waived here. So we're not really seeing 90 plus day delinquencies in that space. But in every other space, we are seeing upticks in the 90-day plus delinquency rates from credit cards to home equity loans to mortgages, although mortgages are still very low and home equity loans are very low. All the other debt, credit cards, and auto loans have really started to tick up. And why would that be? Because if you're going to make your payments, you're going to pay most likely for your home or your shelter before you worry about your car or your credit cards, right? And so it'll be very interesting to see how this progresses going forward. So housing data is another gauge we look at to determine, consumer health. The monthly housing market across, this is looking at several major, well, nationally and several major metropolitan areas, excuse me. These prices have all gone up. We were hoping, or some people, many people, especially younger generations, were hoping that they would see the price of houses come down so they could buy their starter home or whatever. But sort of across the board, prices continue to go up. And while in some areas they've ticked down, in aggregate across the country, the trend is still higher. It's great for older generations because you have all this equity in your house, which you could potentially tap or use in different ways. But it makes it very difficult for younger folks to, move away from renting and into owning. The other interesting piece here, the chart on the right looks at new listings. And so prices are continuing to go up while the supply continues to go down. And if the supply continues to go down, new listings stop showing up, it gives more pricing power to the people looking to sell their house. So this is a tricky place because on the one hand, I love looking at Zillow and finding my own house and seeing, oh, look at that. I've gained another however many dollars in the value of my home for doing nothing, just owning it. But I also empathize with those folks fresh out of college or just starting their careers who are just priced out, just completely unable to get into this market without some type of help. So again, this sort of dovetails into this idea of social cohesion that Alexandra and I talk about a lot as well. If you have a young population who's very restless and feels like the system is not working for them, is that going to work moving forward? We'll see. All right, shifting gears a little bit, looking at corporate health. So how are the companies doing? So we've looked at the consumer, we've looked at manufacturing, we've looked at our risk indicators. Now we'll look at companies. How are the different corporations out there doing? Earnings growth rates and expectations for the next year generally look good. So the companies are making their forecasts saying, hey, 2025 into 2026, our revenues are going to increase, our net income is going to increase, and our earnings are going to increase. 2026, things start to change a little bit. But I have a feeling that's just sort of how a lot of these analysts work is they're really only focused on the next quarter, but you're really only looking forward about a year or so. This chart's really interesting because Alexander and I have talked a lot about the market breadth or how many companies are actually participating in the index going up, right? So the index, the S&P 500, it's hitting these new highs left and right, or it's at this almost near a new all-time high, which sounds great. And you'd think, okay, S&P 500, 500 largest companies, that must mean the economy is doing great. Again, when you sort of peel back the layers and look under the hood, you realize, okay, the Mag 7, which is, the 7 largest companies, NVIDIA, Microsoft, Apple, Google, Meta, Amazon, represent something like 37% of the index. So the other 493 companies only represent about 60% or so of the index. So that's at first should get everybody's eyebrows like, wait a second, so yeah, these 7 companies are doing great. The other 493 could be doing terrible, but you wouldn't know because the Mag 7 are doing so well that it's pulling the whole index up. Um, when you look at this chart, it really shows the projected earnings growth year over year, what is anticipated for 2025. And the vast majority of it comes from the Mag 7. So there is a thought that towards the end of the year, it should disperse out a bit more and we should see some uptick in these companies. But I mean, it's hard to even know what's going to happen tomorrow. So predicting a year in advance around earnings, we'll see. But again, it just speaks to that market concentration, which is a concern of ours. Another concern we're seeing is bankruptcies. Corporate bankruptcies hit a new 14-year high in 2024. We haven't seen bankruptcies do this since, right during the time of the great financial crisis. So this is another really speaks to the idea of the index and markets being skewed because of these 7, I don't want to say magnificent companies because there's issue with that, but these 7 massive companies doing so well because they're just gobbling everything up, while the remaining Main Street, mom and pop shops, all these different other things are in a much different situation, a much more difficult environment. When you look at it by month, it's just been increasing. So a trend we're watching because this, again, really speaks to the health of Main Street. Insider buy sells, just generally looking at different officers and companies. Are they net buyers or are they net sellers? A lot of this activity has slowed over recent months, or is planned, sort of looking forward here is what the planned sales are because they have to report if I'm a CEO or top level management at a public company and I'm going to sell a portion of my shares, I need to report it out and it needs to get sort of telegraphed in advance. And so there's some in the future, but there's been a lot in 2024 in December was a big uptick. Maybe that's anticipation of people de-risking because of uncertainty of the new administration. We'll see. So here is some charts looking at corporate margins and growth sales of different investment grade bonds. So this is just aggregated data of generally what do they look like. Sales growth is expected to expected to recover, albeit slowly. I mean, that's this. Okay, hopefully it does. We'll see. Investment grade margins have really flattened since 2010, which isn't surprising for these companies. So this isn't great, right? Again, it's saying there is still that market concentration. I've heard talk about it, sort of dispersing and spreading out to the other 493 companies, but looking at the charts and, some of this data, it says it sounds great, but the data doesn't really show that that's actually happening yet. Not to say that it couldn't over the next several months, but as of right now, it hasn't really shown up. All right, pivoting a bit to some global data, just sort of looking at some of the global macro themes that are out there. S&P Global does a really nice job actually of putting together some of what are the major risks domestically that we're facing right now. Things from tariffs to interest rate issues, escalating geopolitical tensions, and then issues with cash flow that could affect CRE or commercial real estate, which we talked about extensively in the past. There hasn't been much change in that space, but those issues, they still exist. Nothing's really changed out there. It's just nothing's fallen apart yet. So globally, geopolitical tensions, protectionism, interest rates, all these things are happening. I mean, a sharper global economic downturn. If you've been following anything that's happening in Europe, they're having a really hard time right now. You could argue it's the result of certain policies, but they're essentially their economy is in a tough spot, and it doesn't look like that's going to be changing anytime soon. A lot of the emerging markets looked like they were going to do well, but then the dollar got really strong and is still holding these really strong levels, which hurts those economies. So it sort of speaks to where we should position the portfolio and where we want to be currently. We had started to look at emerging markets, but sort of pulled out because the conditions just aren't there yet. So we're not in Europe too either because just you look at the manufacturing data, it's horrible. Um, and there's a lot of political unrest over the pond too as well, with different parties really commanding um, uh, large swaths of public opinion changing. There's a whole lot of change afoot. Global credit cycle. Let's see, what is this really telling us? That's a little too esoteric. Global GDP growth um, is generally slow. I mean, this is an interesting chart from S&P Global. They're looking at sort of forecasting GDP of different areas from the US to the Eurozone to Asia to emerging economies. Um, and they don't look stellar. They're not saying like, hey, we're entering a new era of global growth. If anything, they look stagnating and in many places contracting. So again, it's not a huge boost of confidence to say, yeah, we're going to have major growth over the next decade. It kind of says, there'll be some growth, but it'll probably be muted. All right. So looking at markets, just some ratios between different things, just to give you an idea. This is looking at large cap companies or, billion-dollar plus companies versus small companies, much more smaller companies. When you see this ratio go up, which we're seeing, it means that the larger companies are dominating. And it looks like that trend is set to continue. What this signals to Alexandra and I is that if we're going to enter the mid cap, small cap space, we need to be extremely selective of what we would want to buy in those areas because the general trend is that why expose ourselves to these when these larger companies are just performing so much better. And next, again, looking at the United States versus the rest of the world, ex the United States, so not including the United States, but developed countries, so things like Europe, the Far East, certain areas like that. And you can see the US just dominates and continues to dominate. And until we see a major change in this trend, the expectation is that it will continue. Same with the US versus emerging markets. The US is still just dominating. This is an interesting chart because it shows gold versus TLT. TLT is a proxy for the 30 or 20-year treasury bond. And so generally you'd want to see this flat. The fact that you see it going up is saying that there's a lot more faith in gold right now, or a lot more people moving to gold as their safe haven asset instead of long-term US government debt. So it's an interesting tell or signal that the market's saying, hey, we're really uncertain about what the future is going to hold. But we know that gold has been this historic hedge and has a history. And so maybe we want to stick with that. So that is all I have for slides. I know that was a lot. So let me just unshare my screen. And then if anyone has any questions, feel free again to throw them in the chat. I had a few questions pop up. I'll try to go over them briefly. But before I do, the general takeaway is that there's a lot of uncertainty out there around policy and just how it's going to affect markets, the economy, manufacturing services going forward. And so Alexander and I, what are we doing in response to that? We have generally a more conservative portfolio overall. We like having a slightly higher cash balance at this time because we can still get a decent yield on it in our money market funds. We want certain exposure to the stock market, things like technology, energy, which we have through MLPs, which have been doing great. Certain tech companies, we have exposure to a bunch of those giants that I was talking about, that meant those Mag 7 companies, and certain financial companies. The exposure there makes sense, at least in the short term, until we get more clarity about what is going to happen over the next few months, which we should start to get and should start to show up in the data. I'd say within the next 3 months or so, we'll have a much clearer idea of where of how markets and the economy are really digesting all of these changes. So generally, we believe being in this more defensive positioning makes sense given the conditions that we see. But that said, it's not like we're all out of markets. We still have exposure to the areas that we like. Um, so I had a couple questions come in that were what sectors of the economy should theoretically do well under Trump, or under the Trump administration. Um, it, it's generally because his stance on things like deregulation. You should see companies that engage in M&A or mergers and acquisitions, which would be those major largest companies because they have the budgets to buy them. They should do fairly well in that type of environment. Generally, financials due to deregulation should do well in that type of environment. Generally, energy should do well under this type of administration because energy-friendly policies. Maybe infrastructure, maybe certain infrastructure, but it can be a mixed bag. So I'll leave it at those areas for now. And we have exposure to many of them too as well. So I do feel good about that. Let's see. There was a question around cryptocurrency. I won't spend too much time on it. What is interesting today is that we have an administration who is extremely friendly and receptive to that space as a whole, whereas the previous administration really took a much more hostile approach to this space. And I'll try to keep my personal opinions out of it, but generally you had an environment that was very anti-crypto because you look at this space, something like 90% of it, 95% of it even is grifts and scams and vaporware. But that remaining 5% or so is this truly revolutionary technology that stands to change so many things, potentially to result in better outcomes for all of us, potentially. One of the major pushes we're seeing is this idea of tokenizing real world assets, or basically taking things and moving them on chain. So now you can have your car tokenized as assets, and then you can get theoretically like a whole history of all the repairs on it. It has the potential to increase transparency tenfold, but again, these things are tools, and it matters how they are used. So moving into a new regime that is much more friendly to the space should bode very well for crypto markets as a whole. A lot of volatility, most likely to be expected, but generally, I think we will get much clearer guidelines and much clearer rules and regulations around how the space should operate. A lot of these things, the previous SEC, Gary Gensler, took very negative approaches to it. Really didn't take innovative or thoughtful approaches. There were people on their team who were pushing for these things, but generally took a negative stance towards it. So moving forward, having someone who's willing to engage the space in a much more productive way, we could see some really positive tailwinds in the crypto space because of that. Another question. So let's see. All right. So let me just read these questions really quick and see if I can answer them. I like this one. No slides on my vacation. No, there are not. I'm actually at home today. It is a cold day at school, so the kids are home because it was too cold to start the buses, apparently. I know I went to the gym this morning. It was -9 degrees. That's what my car was telling me, and the real feel said it was -20. So that's always fun. I wish I was on vacation somewhere warm. All right. Let's see. How do we evaluate the strength of T-bills and notes? I mean, that's a great question. I don't know if I can answer it fully right now, but basically, we're looking at the United States' ability to pay its debt, right? And we're all sort of on the same page that as the world reserve currency and the largest currency that is used for global trade, that we have this unique ability to print money in order to facilitate global trade, and that we can run these deficits because of our unique status as that reserve currency holder or the purveyor of that reserve currency. Um, and so where I would look for worry would be number one, in those more esoteric global liquidity markets, if fractures start to show up there, that starts to send a warning sign that, hey, maybe even treasuries aren't safe. This hasn't happened yet. And it might not happen anytime soon, though I can't say it will never happen, right? Or if the United States all of a sudden, whether it's through policy or something else, decides, hey, or debt ceiling, whatever, we are not going to pay our debts. And if we default on our debts, it really sends a signal to the rest of the world that, hey, this reserve currency asset is not as safe and stable as we once thought it was. What happens from there is anybody's guess, but generally probably wouldn't be that good. But as of right now, these things are still very well entrenched and intact. So with treasury, do you think we should? So do you think so the question I'm seeing is, do you think we should take longer term treasuries, like 3 years, 5 years, 10 years? At this time, we prefer to remain on the short end of the curve, meaning we wouldn't want to buy things more than, say, 3 to 5 years out, because there could be some drastic changes in interest rate policy. We don't know. The Fed is saying they're going to cut only once. And remember, when the Fed cuts rates or when yields go down, the price of bonds go up. And so theoretically, if we were in a real cutting environment, holding that longer term debt pays off, because as rates continue to go down, the value of it continues to go up, and then you could sell it as a trade or something and potentially make money there. I'm not saying that's the best thing to do right now, in our current environment. Again, like I said, we want to be in that sort of 0 or like 1 to 5 year range with our bonds. We get decent rates in them right now. I mean, they're around like the 4.5 to 5-ish%. So that's good. We like that. It might make sense to lock in longer term rates. But I would wait, because what we're happening with the yield curve is it's in this transition period where it just was inverted for so long and now it just uninverted. And this is a transition. So it hasn't found its new home yet, right? Usually it'll ultimately get somewhere and then stay there for a few years until, the data changes or new risks pop up or whatever else. And we haven't the cycle hasn't ended yet. So if it continues to normalize and long ends continue to go up, then maybe it does make sense if you can get 5, 6, 7% right on a 10-year. Why not lock it in? I know in the 70s and 80s, there were periods where longer term treasuries were paying upper teens in their percents, and that'd be pretty great. But it also makes for a very different world in that type of environment. So we believe sticking with the short end on our bonds makes sense at this time. So the next question is, the stock market as an index, is it misleading? Right. What tells us how the non-giants are performing? Right. So the stock market as a whole, if you just use that as your gauge of the economy, just understand that you're really only getting, or it's highly, highly influenced by those largest companies that make up the largest percentage of the index, and then everything else. So when people say, oh, the S&P 500 earnings were great, well, were they, or was it the top 7 companies that were great? So how do you track the other ones? There's other indices of like small cap indices or mid cap indices, and you track those and you see that their performance is nowhere near as good as the S&P 500. So we have a whole bunch of different ways to track those. All right. If the USD, last question, and then I'm going to wrap this up because it's been about an hour. If the US defaulted, then corporations would be affected, and those people would not want to default. Yeah, if the US defaults, it really enters into a big unknown. The US hasn't defaulted anytime in recent or memorable history. So how that would affect our massively complex and connected world today can only speculate. theoretically, I'm just going to go off on a tangent here. I don't know if this is anything, but I've always had this. I read a very interesting article about what do they call it? Um, techno. I forget what it has to do with a technocracy or something like that, where you have these large companies, the largest companies, which you look at Apple and Microsoft, I mean, they have market caps larger than countries, entire like developed nations too. So they almost are like their own digital nations at this point. And if data really is becoming the new oil, um, who has access to all that data? These large companies. So that puts them in a position where um, they almost become their own like digital nation states. And so then it's like, okay, do I want to buy bonds in a government that is defaulted or in this corporation that has its fingers in everything? It kind of presents a bleak potential future, but who knows where we'll end up. Um, Again, the long and short of it today is that going forward, we are more defensive in our portfolio. There's certain sectors we do like, certain technology, those large cap companies, nothing looks like it's changing there. Certain financials, certain energy companies all look good, and we are in those spaces. That's where we want to be. Um, and having a higher cash balance right now lowers overall volatility, which we also like, um, until we get more idea or a stronger sense of what is coming down the road. And so with that, I'm going to stop talking. It's a lot I threw at everybody. If you have any questions or would love to talk further about this stuff, you've got mine, you've got Alexandra's email. Feel free to give us a call. We're in this stuff daily. So without anything else, thank you for joining and sticking around this long. Really appreciate it. Take care,
Thank
everybody,
you, everyone.
and stay warm.
I was listening.
Excellent. All right.